Namaskara guys, this is Stock Yatra and we are looking at a series of video lectures on the basics of the Indian stock market. We have completed 5 video lectures so far. We'll start with the 6th video lecture where we'll be discussing about the different types of investors and the types of orders that you can place. Moving on, we'll first look at who you identify as. So this is basically the type of investors. The type of investors can be divided based on two different aspects. One is the duration of your holding. The other is your total capital. Based on capital, you have these many individuals. FIIs are foreign institutional investors. For example, Vanguard, Oppenheimer, Franklin Templeton, Government of Singapore, BlackRock, all these are foreign institutional investors. They are large institutions that invest funds that they collect from various sources into the stock market. So they are basically based not in India but in foreign countries. So that is why they are called foreign institutional investors. Their Indian counterparts are called domestic institutional investors. They are large institutions that invest in the stock market. They consist of the Indian mutual funds, insurance companies, local pension funds, banks, and financial institutions. All your mutual funds and insurance companies, they basically invest into the stock market, and they form a part of the domestic institutional investors. Then we have high net worth individuals and retail individual investors that are collectively called the NIIs or non-institutional investors. High net worth individuals have high capital. All these people that you see here are high net worth individuals. Rakesh Jhunjhunwala, then you have Dolly Khanna, then you have Ajay Kedia, then you have Poranju Valiat, you then Amish Shah, Anil Agarwal, and so on. They are high net worth individuals. Then we form the part of the retail individual investors. Our capital is not as high as the high net worth individuals. We have a low capital and we fall under retail individual investors. This is based on the capital. Now, based on the duration, we have these are not strict classifications, these are flexible classifications. Hence, my definition of a long term investor will be different from someone else's. Likewise, short term swing trader, but intraday trader, everybody's definition is same. They square off position within the same day. We have discussed this earlier too. Scalper is someone who trades only for 5 to 30 minutes max. They enter at 9:22 and they exit at 9:36 a.m. So this person is called a scalper. They enter with large quantities for a short amount of time. Even small movement of 0.5% is enough for them. They will start exiting or squaring off their positions. Swing trader. Swing trader is an important concept, or it is the one of the most rewarding type of investment. It is basically a share price keeps fluctuating, but once it starts moving into a swing or taking a trend, let us say it is an upswing, entering at the start of the swing and exiting at the end of the swing is what a swing trader does. So it can be the other way around also. So he can enter at the start of a down move here and square off his positions at the exit of the down move. This is what a swing trader does. In terms of duration, the swing trade can last from a few weeks to a few months. And this is one of the high rewarding investment durations that you can look at for small time investors. Then you have short term investor whose holding generally varies from 6 months to 1 year. And long term investors, anybody who holds for more than 1 year, are long term investors. Now we'll look at the types of orders. The two main types of orders that we look at are the limit order and market order. So limit order, you are bargaining. You are saying that you want to buy a share of ABC company. Let us say it's LTP. LTP is at 200 rupees. You say, or you place an order with the broker stating that you want to buy it only when the LTP reaches 120 rupees. So this is how you place a limit order. The limit price is 120. This is called the limit price. The price at which you want to buy the share. This is technically bargaining in layman's terms. But in market order, you are not bargaining. You are buying at whatever is the CMP at the moment you place the order. There will be a button called place order. Once you hit this button, at that moment, whatever is the CMP, the order will get executed at the CMP price. So this is basically, you are not bargaining, you are going to buy the share at whatever is the price at that moment. And we saw what is stop loss. So stop loss order is basically, you are mentioning the stop loss price. It is a type of GTT order. Or it can also come with a one cancels another order. So we'll look at both in detail. A GTT or a GTC order is good till cancel order or good till trigger order. Here in limit and market order, we have to mention, in limit order, we have to mention the quantity or the number of shares that we want to buy and the limit price. In market order, you don't need to mention the limit price, you mention only the quantity and hit the place order button. But in a GTC or GTT order, you have to mention one more field, which is nothing but trigger price. So trigger price is another field that you have to mention. The advantage of placing a GTC order or GTT order is that you get to extend the validity of an order. The normal limit and market order validity is only for 1 day. So today at 4 p.m. once the market closes, the orders that I've placed will get cancelled on its own. But a GTT order will not get cancelled within the same day. The validity can be extended up to 30 days to 1 year based on your broker. If you want to buy TCS share, once it comes down to 400 rupees, but the LTP is at, let us say, 700 rupees. So instead of logging in daily and placing a limit order to buy at 400 rupees, you can place a GTT order to buy at 400 rupees and leave it alone for 30 days to 1 year based on your broker. You don't need to log in every day and keep typing limit order to buy TCS shares at 400 rupees. So in GTT order, we'll look at what is the difference between a limit price and trigger price. Basically, to extend the validity, GTT orders stay dormant or inactive. Okay, they are inactive orders. You have to mention the trigger price. The trigger price is the price at which the inactive order becomes active. The GTT order, once the trigger price is hit, it will turn active into a limit order, normal limit order. So this price is called trigger price. And the price at which you want to buy, just like the limit order, is called the limit price. This is the advantage of a GTT order. Now stop loss order can be placed as a GTT order or one cancels another order. In one cancels another, you provide two different limit prices. One is the target price, the other is the stop loss price. So let us say you buy a share ABC at 300 rupees. Your target is you want to sell the share when it reaches 600 rupees, and your stop loss is 200 rupees. So you can place a one cancels another order for a target of 600 rupees. Target price will be 600, stop loss will be 200, and likewise you will have to place a trigger price for both stop loss as well as target. So it is like placing two GTT orders in one. If the target of 600 rupees is hit, the the share will be sold at 600, and this stop loss order will be cancelled automatically. So if one is hit, the other is cancelled. That is what we call one cancels other. Vice versa, if the stop loss of 200 is hit, the target order will be cancelled and the stock will be sold at the stop loss of 200 rupees. This is what we call the one cancels another order. This is how you can place a stop loss order, and you can also place a target order. In some brokers, this GTT order is called a robo order. Only the name is different, but the thing that it does is the same. The immediate or cancel order is like you placing a market order. You want to buy it at 300. It either gets executed immediately. If it does not get executed, then it will be cancelled immediately. This is basically useful only for large investors. Small time investors need not worry about all these. Likewise, we have three different orders. All are none, minimum fill, and disclosed quantity. They are basically useful for high value investors or high net worth individuals. For small time investors, these are not quite required. We'll discuss them in a separate video. If you want to look up on them, you can do so. I will attach the video in the description. You can watch them when required. That's all for video 6. Stay tuned for subsequent videos. Like, share, and subscribe to Stock Yatra. Thank you. Jai Hind.